I hope everybody is now properly stressed just the correct amount about the exam, not too stressed, and also not less stressed than you should be, because obviously stress helps with getting a good result in exam, in studying well. So we'll go through the pre-scene that they have issued, the institute has issued. There are some areas in the pre-scene that are really not relevant for us. And also the most important thing you have to remember is that you cannot take this pre-scene to the exam. So you have to either very properly, correctly remember everything that you are learning from the pre-scene analysis, or you have to think of some smart way to carry this to the exam hall, because you cannot take this particular piece of paper to the exam if you have taken a printout of it. So the most important thing is remember that. So you will get the pre-scene at the exam, you will have to use that. Whatever the analysis we are doing, think of a way how you are going to carry it to the exam. That's very important. Then the other thing is, now when you get the pre-scene, don't try to find out which company they're talking about, which company are they talking about. Surprisingly, there is a company with the same name listed on the Colombo Stock Exchange. So don't go to find out what which real company they are referring to. Because there's no point in doing that, right? You will be given whatever the information you are required for the paper in the pre-scene and in the unseen that's given to you in the exam. You don't have to go around and then look at the business environment and everything. You are not expected to do that at this level. Of course, SL5, when you are doing the case study, you will have to do that, but that's a whole separate story. Once you're done with this, you can get there. So that is for this. So common pre-scene, December 2021, this is important for you because this carries 50 marks. The entire section 2 is based on this. But we can't say the question is always going to be based only on the information they are giving in the pre-scene. Sometimes in the exam, what they are going to do is they are going to give you the information of a whole separate new company, new transaction, and then there is very little use for you in the consolidation question from this pre-scene. But of course, since now we have the risk of material misstatement, that part also within SL1, that is an area where you can easily score if you properly analyze the pre-scene. So today what we are going to focus more on is that part, because that's why I can tell you these are the areas, these are the answers that you need to write if this kind of question comes up. So that is what we are going to focus more on, because the console question, I don't want to tell you that this kind of question will come. Obviously, for one, I cannot tell you. I don't have that power to read the examiner's mind or whatever. And also there is no point in doing that, because obviously you will get confused, right? So console, that part of it, we are going to give less focus. I'm going to focus more on whatever the marks that we can score for sure through a pre-scene analysis. So these are the areas that we are going to look at in the pre-scene analysis. The first thing is, obviously we have to understand the group overview. How does this group look like, and what are the companies in that group? How does the shareholding look like, that part of it. Then for again, for the financial reporting, the old CFR part of it, we will need the financial statement analysis. So that we will do. Then this is already done. You also can do it on your own. Then the other thing is, for consolidation, I will tell you what information we are given, so that in the exam you don't get confused with what information to use and from where to take that. So now, for example, when we were discussing past paper questions in the class also, our main issue was, I will tell you, okay, number of shares is this, and the students will be like, okay, from where did the number of shares come from? So that we will sort it out. So in the exam, when you go and sit in the exam hall, you will know, okay, if I want the number of shares, was it in the pre-scene or should I take it somewhere from the paper, the unseen part of it? So that we will sort it out today. Then, most importantly, on the second volume 2 part of our syllabus, we will discuss about these areas. So we will discuss any ethics related issues, and then corporate governance issues and suggestions, and then internal controls. Of course, that is an area where you get tested often, internal control weaknesses and suggestions. And then risk of material misstatement, which is the most important part. So if you have already read through the pre-scene at least once, you may have found out that this company is a mess in terms of the internal controls that they're having, and also that there is a lot of risks of material misstatements in this company, the group. So that is an area where you will have a lot of things to write about. So these are what we are going to discuss today. We start from the beginning, from the pre-scene. It's important that you also get familiar with the pre-scene, what's in it, and what's relevant for your SL1 exam and what's not relevant for you also. So I'll start from the beginning, and then wherever relevant, we will come and fill this sheet. So what you can do is, I'm not sure whether one sheet is enough. Normally in the class, we take just one sheet for the short note. This, I'm not sure whether one sheet should be enough. So maybe you can take a few pieces of paper, and these are the topics that you are going to discuss. And wherever we come across something for each bucket, we will come and fill it in. So we are going to talk about the group overview and the financial statement analysis. Then the consolidation, information for consolidation, that question. And from volume 2, it's going to be ethics, corporate governance, internal controls, and risk of material misstatement. So you can have these separate pieces of paper, or on the same sheet you can have it. We will go through the pre-scene and fill these boxes in whenever we come across relevant information. If you have any questions, I think you can let me know in the chat box. I won't be able to read them as I go, but at one point I'll stop and then I'll check any questions that you may have. So we'll get started from the beginning. So again, I'm telling you, there are things that are important for us in this, and things just, the story, the background story. It's nice to read where these people learned and all of those things, which are really not important for us. We'll start from the beginning. I have highlighted whatever that I want to be highlighted, so we will pay attention to those. Equip Office Solution Private Limited is the name of our company. So this is a private limited company. Then the group is also, we don't have any listed companies in the group either. So one possible area is the company going for an IPO listing. So recently in the market also, many companies went for IPOs. Some of them, which happened earlier, were successful. Then some which happened towards the end of the year were actually not very successful. So that's one thing to keep in mind. And anyway, there have been some questions in the past also. If the company goes for a listing, if it goes for an IPO, what will happen. But in that case, that's of course again not so much for financial reporting, but they can ask you how should the audit committee should be developed as per the listing rules. So audit committee, the remuneration committee, all of those corporate governance and ethics parts, they can test you. Okay. So background, we have Henry Emanuel, who's the founder of this company. So we have information about him. Then he established Equip Office Solution Private Limited with 80% equity stake, and his brother George Emanuel joined him on in the remainder of 20% equity in the company. So this is regarding the share ownership of the company, but this is way long back. It's in 1966. So we want the latest shareholding, which this changes. So we are not going to write anything. Just remember, Henry is the person who started the company. Then he has 4 children also, Herbert, Eric, Christina, and Rehan. So one more thing very important about the pre-scene is you have to remember these names. All of a sudden, they will, in the question, in the paper, they will be like, Herbert acquired this company, or Herbert sold his shares. So then in that case, you have to remember who's Herbert. So be particular about the names that they have given, who these people are. And also not only the names of people, but also you have to remember the names, the abbreviations of the company. So they will say EOSL. Now EOSL, we have to remember, is the holding company. EOSL is the holding company. So you have to remember the abbreviation, because in the question they will say EOSL. Now this company, it's all vowels. Now we have EOSL, IOSL, then H something. So ECL, it's all E and L and all of that. So very important, you remember the abbreviations also, and where each of these companies stand in the group structure. Then Herbert, Eric, Christina, and Rehan are the people. Then the next part is okay. They are talking about 1977 open economy. And now we have the second generation. Current chairman is Herbert Emanuel. Yeah, he joined the company. So the second generation is also joining the company. What's important here is that, again, this is a private company. So all those corporate governance, the code of best practices on corporate governance, those things are not that important for a company like this. So if you have read the study pack, they are talking just a little bit about this company's structure, which is common in countries like Japan, where you have privately held ownership. So that's one thing to remember. It's all within the business. This is the case in Sri Lanka also, right? Like if you take the Abans group, it's all it's within the family members. So the directors, the chairman, and everybody is from the family itself. Then we go further down. We don't have anything very I may chairman, and then what I was saying, have a company Equip Communications Private Limited, which is ECL. So when you see the word ECL, remember it's Equip Communications Private Limited in this case, not expected credit loss. Then Equip Computers Private Limited is so just remember the abbreviations, because otherwise in the question in the exam hall you'll be like who's ECL and who's ECPL. So we have 2 companies. We need to figure out how the group structure works. Let's see whether we have more information. What is the percentage of shareholding and all that. Then we have Eric Emanuel, who's the deputy chairman of the group and the current group director, Shockman the Silva. So what we can do is actually we can go and write this down under corporate governance. Corporate governance, this falls under board composition. So this is something important for us. Board composition. Why is it? So the first one, board composition. Why is it important for us? We have to look for diversity because a good board of directors that helps to carry out good corporate governance in a company should be diversified. You should have all sorts of experience, relevant experience to give a good leadership to the company. So we are going to look at the board composition. We have the chairman, then we have a deputy chairman, and we have another director. You can write down their names. Eric, Schockman, and Herbert. This person is not SCH. Shockman de Silva. So we have chairman, deputy chairman, director. So we have to figure out what the qualifications these people have in order to determine whether we have diversified talent within the board of directors. Qualified chartered engineers. So Eric Emmanuel is a qualified chartered engineer, and also Shockman de Silva is also a qualified chartered engineer. So we have two engineers, qualified chartered engineer, and we also have another qualified chartered engineer. So these are the qualifications. So far, no no diversity in the board of directors because both of them are engineers. Nobody with financial acumen. What do we want? We want financial acumen, which we claim that chartered accountants have. So it's good if we have a chartered accountant on the board also. We need financial acumen in the board. Then we go further down. The four children joined as directors to the board of EOSN. So we have them also, four children of Henry. So the four children of Henry, the names were Herbert is already there, Eric, Christina, and Rehan. Eric, Christina, and Rehan. These people also have joined the board. All of them come from the family itself. So nobody independent. We don't know whether this he's heading another group of companies. So we have to see now. There was rapid growth. Another fully owned subsidiary of EOSL, EEL, was established in 2005. Now, so far we have three companies in addition to the holding company, EEL and ECL and ECPL. So we have three more companies. We can put it here. We'll figure out the holding ownership percentages later. ECL, EEL, and ECPL. EEL, ECL and ECPL. So those are the companies under EOSL. EEL was established in 2005, and Christina, who graduated from the University of Moratuwa with a BSc Engineering, okay, another engineer, was appointed as the CEO of EEL from inception. So she's a director and she's also the CEO. She's also a CEO. Again, she's an engineer. Again, no diversity in the group. To comment on the board composition, so far what you have to write is there is no diversity in the talents that these directors bring into the company. So if there is something different in the way that studies is lectures are done at Moratuwa, and these people I think qualified from foreign universities, so maybe that's the only diversity we have so far. Then Henry Emmanuel stepped down as chairman of USL, and Herbert Emmanuel was appointed in place with 80% equity ownership. Clearly the favorite child. So 80% equity ownership. Henry wanted to spend the rest of his lifetime joyfully with peace of mind. Okay. Herbert is again a chartered engineer. So we have too many engineers on this board of directors. Again, no diversity. Qualified chartered engineer. We are okay. It's good. Managed to learn the cities, and then we have about his people. Then his employees received okay. I think there's a bit of a lag with my screen transition. So his employees received the highest salaries in the industry until the recent past. So these people, when they had high profits, they managed to recruit good talent, giving very high salaries. But the until the rest. So meaning maybe now they are not giving such good salaries. So in that case, of course, people will be demotivated. That's for SL4. But for us, for SL1, what we have to look at is what will the employees do when they are not getting good enough salaries. What can happen? They may try to commit fraud. We have a rationalization. That is one reason for you to do fraud. Rationalization, saying, okay, they are not paying me enough, so I might as well steal something from the company. So there is a little, I'm not saying this is like a major point that you should write at the beginning of your answer as risk of material misstatement, but yeah, it's something that you can write down the line. So I will go and fill it here. And risk of material misstatements, I'm going to write it here because we have more important ones to write. Risk of material misstatements, I am going to write risk of fraud due to demotivated employees. So this is not something you should write at the very beginning, remember. Somewhere down the line you can write that. Risk of fraud due to demotivated employees because they are not getting the same salaries that they used to. Okay, so this entire paragraph is okay. Then Herbert tabled, Herbert is now the chairman. Important, remember the names. Herbert tabled a proposal of acquiring 80% equity shares of Heller Transformer Private Limited, HTL. So we have another company then, which is HTL, which is owned by his good friend Anton Dimmel in order to bail him out from financial difficulties. What has happened? The board of directors of EOSL, the other brothers, have rejected the proposal. They are saying they don't want inorganic growth. They want organic growth. What is inorganic growth? Is when you try to acquire other companies. That is what's not coming within your group. So when you are trying to acquire, that you call inorganic growth. So they are saying they don't want that. And also they have a company which is in the same industry. But Herbert convinced the board to consider this as an exceptional case and invested money in HTL by purchasing 80% of equity shares in HTL, adding another subsidiary. So one thing is we have to go here and add HTL to our group structure, HTL, and we know that it's 80%, subsidiary 80%. Then the other thing is regarding what thing is regarding what Herbert, the chairman, did. What does it say? He is dominant. Even though all the other directors, all the other people said no, he still managed to get his proposal through. So dominant. This is not appreciated when it comes to corporate governance. So one person should not have dominance in board decisions. So note that also down as a weakness in the corporate governance of this company. The chairman is being dominant. Okay, then we come to the next page. Rehan Emanuel, having 5% of shares, decided to start his own business venture, sold his shares of the company to the elder brother, Herbert Emanuel, and quit from the directorship as well. So what we have to do, we have to go and update our director composition because Rehan is no longer there. Let me just put a cross here without deleting. He's no longer there. Rehan is no longer there. Instead, they have got a new person. Prasanna De Silva was appointed as a non-executive independent director, Prasanna De Silva. And okay, good. Why? A fellow member of the Institute of Chartered Accountants of Sri Lanka. Now we finally have somebody who has financial acumen. So he's a fellow member, FCA, Prasanna De Silva, non-executive independent director. I'm writing his name here in the board composition, Prasanna De Silva. He's an ACA, so now he's bringing the financial acumen. Then he's a independent non-executive director. Now, what's our situation? Prasanna De Silva, FCA. All of these other people, Rehan is no longer there. We have 1, 2, 3, 4, 5, 6. We have 6 directors, and out of those 6 directors, If we exclude the chairman, we have 5. And out of them, we have only 1 independent director. So that is an issue. Since the chairman is not independent, we should have at least 50%. So now this is an issue. So regarding the board composition, that is an issue. Eric is not here. So Eric. So already there. So we have only 5 directors. 1, 2, 3, 4, 5. And out of those 5, we have only 1 independent director. So that is an issue with the board composition. Okay. Then Rehan, but good thing we can be happy about is this Prasanna De Silva. He brought in financial acumen to the group, the board of directors. Rehan Emmanuel established a company called Innovative Office Solutions Private Limited, IOSL, in year 2011 that was similar to EOSL. So we have IOSL also, but this is not within the group. So we are not going to put it here. IOSL is not owned by the EOSL holding company. It's owned by this Rehan who left the group. It's owned by him. It's a separate standalone company. Remember that though, because remember IOSL's name, however, because it's coming up later. As a principal, he did not approach any corporate customers of EOSL. So this is something we could have written as a threat that he may have poached some of the customers, but he has not done that. And that is good. Then we have the vision, mission, and values of EOSL. We don't want that. We don't need to pay attention to that. Keep it like that. We go further down, we have values, and then we come to the important part, business operations. So this business operations, this is very important because this is where we have our internal control weaknesses and also the indications of risks of material misstatement. So we'll start business operations. EOSS, dealers and distributors are an essential part of the nationwide sales network, while the registered foreign suppliers and local suppliers are key components of the EOSS supply chain. So they have dealers and distributors. What happens is now for a brand like, let's say, even LG, they can have their own showrooms, or they can have a dealer distributor, somebody who will act as kind of an agent. So what happens is when you appoint a dealer or a distributor, obviously there is going to be inventory that's held with those people. Then because of that reason, you will be getting a security, some kind of a security from those people. And then there will be receivables from these people. So one thing is now under risk of material misstatements, at your level, there are certain areas that we need to look at. It's in the study pack also. We have discussed in the class. We have certain areas where you have to assess the risk of material misstatement. So there is the group accounting. When you do consolidation, there can be a risk of material misstatement because there can be related party transactions and then the consolidated adjustments. So there can be material misstatements on consolidation. Then overall on financial reporting, there is a risk of material misstatements on journal entries. Then financial reporting, the computerized environment, there can be risk of material misstatement. Then importantly, there can be risk of material misstatements regarding the revenue recognition. For a normal company, I'm not saying for this company, for a normal company, revenue recognition. Then also there can be for inventory, then any risk of material misstatement regarding inventory. Then Accounts receivables. Accounts receivables is also an area where there can be a risk of material misstatement. So here now they seem to have a significant amount of, they should have a significant amount of accounts receivables. So we can identify that as a risk of material misstatement. Why is that? Accounts receivable, because there can be impairment of these accounts receivable. We have to do the impairment as per SLFRS 9. So that could be there because they are dealing with dealers and distributors from whom you are supposed to receive money. There can be impairment, and they seem to have a nationwide sales network. So that is one thing we can note it down there. Then also later in the pre-sin also we have more indications that there can be impairment regarding the accounts receivable. So we will take it as a risk of material misstatements, accounts receivable. Then the registered foreign suppliers and local suppliers are also there. EOSL has implemented, I am now back at the pre-scene, the PDF. EOSL has implemented an enterprise resource planning ERP system, but they use QuickBooks as the accounting package, which has not been yet integrated to the existing ERP system, which had been installed in mid-2019, just before COVID-19. So now this is the issue throughout the pre-scene, this entire description of the business operations. This is the main issue. What is the main issue? Their system is not integrated with each other. Now think this, they have so many dealers and distributors and nationwide sales network. They are dealing with foreign suppliers and local suppliers, but they have an ERP system and then they have a separate QuickBooks, which they are using for accounting. So in that case, their systems, the two systems, is not integrated. This is coming up again and again and again as an issue. So that is one indication of risk of material misstatement. Obviously, when you don't have integrated, when you don't have integrated systems, there can be so many issues because you will have to do things manually. You will have to whatever the reconciliations you will need to do, entering data sometimes you will have to do manually. Then when you have many points of data entry, because at each showroom or at each dealer's place there will be new information coming in. So because of that, these systems not being integrated is one risk of material misstatement. So we will write that down. Systems are not integrated. So we can write that is a risk of material misstatement. And also we can write it as a internal control failure also. Internal control weakness here under this bucket. Weaknesses in internal controls. Systems are not integrated. So that is an issue. So if you remember the internal control, the COSO framework, we have 5 components. One of them was information and communication. So they have an issue in that regard. Systems are not integrated. So proper information and communication flow cannot happen. Weakness in internal control, that also you can write if you are asked to write about weaknesses in internal controls. So make sure you pay attention to all of these areas, because this is one way how you can manage your time in the exam. Right now, when we are talking about your exam, you have to, this is a must, you must make sure you stop writing the answer for each question when your time is up for each question. So please make sure you stick to that rule, because otherwise you will think, okay, I am writing a good answer for this, and you will keep writing. At the end you are getting only 3 marks for that, but you have written a lot, and then you didn't have enough time to write answers for the rest of it also. So please make sure you stop each question at the proper time. Now, for example, for 1 mark, 1 mark is worth only 1.8 minutes. How do we get that? We have 180 minutes and 100 marks. So one mark is worth only 1.8 minutes. So if you have a sub part of a question which is giving you 6 marks, please make sure you stop writing the answer within 11 minutes. Within 11 minutes, make sure you stop that. Wherever you are in the question, stop writing for that. So when you have done that, what you can do is, when you come to the section 2 of your paper, these things, if you are asked internal controls, you can quickly write the answer. Because you are now getting properly prepared for the pre-sim, you can very easily just copy paste the, like, as in just look at it and then write the answer. Then you will have a little bit of time saved. Hopefully you will have a little bit of time, because obviously this is not the same as you have to read the question again and write. No, you just have to write it. So if they are giving you 3 marks, you will not need to take the full time for that. So you can save some time, and then what you can do is you can go back, and if you had some more to write for this question, because you had to stop it halfway, if you had some more to write, then you can go back and write it. So this volume 2 part of the pre-scene is very important. You can score marks easily for that. So please make sure you pay proper attention to that. Okay, so we go back to the pre-scene. Enterprise Resource Planning ERP system, they are using QuickBooks. So this is coming up again and again. We will discuss that when it comes up later also. Existing staff are loyal, been serving the company for a long period. Some of them are having poor literacy in working in the computerized environment. So now this can be an issue. This is a weakness in internal controls, obviously. Poor literacy in working in the computerized environment. Poor literacy of employees in working in a computerized environment. What is the issue with this? Now, this was information and communication in the course of framework, that element. This is control environment. You should have good employees who are knowledgeable in the computerized environment. If you have a computerized environment, so you have computers, but you have people who don't know how to use computers, that is a weakness in the control environment. So that is a weakness in internal control. Then what happens when you have weaknesses in internal controls? Obviously it gets reflected as a risk of material misstatement. So that I will write here. Again, I will write it here because it's not that important. Poor literacy of employees, because I have better risk of material misstatements to write at the top. I will just write it here for now. That is again a risk of material misstatements, because when your employees don't know what to do, there can be misstatements in your financial statements. Okay, again, I'm going back to the present, the PDF. The company maintained a list of registered suppliers in the ERP system. And when the purchase order is created, the registered suppliers are visible to the team. So this registered suppliers is a good thing, right? We have learned about this. When you have registered suppliers and when you are using it in the system, that's good, because then unauthorized suppliers will not get into the system. So one thing we have to be careful here is whether anybody can come and make changes to this list of registered suppliers, right? Like if they have a list of registered suppliers, but then just anybody can come and make changes, add people, delete suppliers, add suppliers. If they can do that, if that control is not there, then that's an issue. You can note it down, but again, it's a thought. It's not explicitly mentioned in this. So it's just a thought. If they have a good control, having a list of registered suppliers is good, but that control is effective only if those changes cannot be done. So keep that in mind. If you want, you can write it down. I'm not going to. Then, if a registered supplier fails to deliver the product within the agreed period, the system automatically blocks the supplier for future orders. Again, it's a good control that they're having. If they are not delivering, the system will block it. So that's good. Again, what we have to keep in mind is who can remove that block, right? If the person who's inputting the data can just go and remove that block also, then there's no point in the system blocking it. You block today and then the next day the person goes and unblocks. So that thing is there. The company has their own delivery system to reach customers to sell their products. The company has their own delivery system to reach customers to sell their products, or else customers could visit their showrooms and they could directly purchase from the showroom. Okay. When the goods are ready for delivery, the operation department confirms the delivery to the delivery team. The delivery team uses its own network method to reach the customers, and the operation department can track the delivery through the GPS system. So this can work in both ways. Now what you can see is they have a delivery team, like the store warehouse people and the people who have the lorries and all that, who do the delivery, and also the operations department, maybe people in the showroom, who do all the marketing part of it, the selling and talking to customers and checking whether inventory is there, that part. So this can work two ways. One thing is they are working separately. The delivery team is using its own network to reach the customers. Operations department is tracking the delivery through the GPS system. So there is no communication between these two teams. The operation department is not following up with the delivery team. Delivery team, they are not calling the delivery team and asking whether, oh, did you deliver that order to these people at this address? They are tracking it through the GPS system. So they may have some kind of a barcoding or something going on where they use the GPS system to track the delivery. And I feel like the delivery team should be the one tracking the delivery, because whether it has reached and all that. So somehow it looks like there is no communication between these two teams, but this can work in favor of us when it comes to financial reporting, because there is kind of a two-way check here. The accounts team, when they are recording whether something has been delivered or not, they have two sources. They can refer to what the delivery team says, and also they can refer to what the operations department says through the GPS system. So that's good. just to keep it in mind. Then when a customer purchases from the showroom, the customer makes a cash or credit card payment to the showroom cashier, and the showroom cashier issues an invoice together with the receipt to the customer. So they can pay in cash or in credit card. Then they have POS, the credit card reading machines and all that. They can make payments in cash also. So cash again is always a risk of material misstatement. Why? Because there can be fraud. Cash is easy. Once you take it from the drawer of the business and put it in your pocket, nobody can come and say, okay, this is your money, because this is not my money. The money is not marked. So cash is always a risk of material misstatement. Cash handling, there is always a risk. There should be a cash count if the auditor is doing a test. Cash handling, and also if you look at the balance sheet of this company, they seem to have significant amounts of cash. So cash handling, of course, there is always a risk of material misstatement. Cash handling, so it can be fraud risk also. Then in general, when you are doing the cash, when you're handling cash, there can be, due to human error also, there can be some material misstatement. So that's again a risk of material misstatement. What happens now when a customer comes to a showroom, the showroom cashier issues an invoice together with the receipt to the customer. The receipt is generated by the standalone invoicing system. Okay, now things get worse. Why? We have another system, a standalone system. So let me go and elaborate. These systems are not integrated part here. Weakness in internal control. We have 3 separate systems. We have the ERP, then we have the QuickBooks, then we have the standalone invoicing system. Systems are not integrated, so this is an issue. Systems are not integrated, ERP, QuickBooks, and standalone invoicing system. 3 separate systems they are using. For online purchases, the customers have to make the full payment online to process the transaction, and that payment is directly deposited into a bank account designated for the particular purpose. Okay, at the end of each day, the showroom cashier reconciles the physical cash collection and credit card payment receipts together with the system generated receipts list and securely stores it at the showroom safety locker. So what do we normally say? It's better if you can go and deposit the cash that day itself, right? Like sometimes you get people to come and collect, sometimes in these urban areas, like city areas, the bank will send a person with the gun and in a that the vehicle that they use for carrying money to ATM machines and all that. They will sometimes send a person, and the bank will send a person so that the shop owners can give the money, whatever they collected during the day, to that person. They will go and deposit it in the bank. So that's recommended because it's unsafe to keep cash with you. Physical control. So what are they doing? Early in the morning on the following day, okay, that's just as good. If you can't do it that day itself, then early in the morning the following day, the showroom cashier deposits the cash into the bank, and the bank deposit slip and credit card payments together with the daily collection reports are sent to the accounts executive responsible for cash collection at the head office. So what is the issue here? Now this accounts executive person must be getting a lot of manual reports, right? If we had a proper integrated system, and then with just a click, this person can have access to all the reports, all the information on the same database. Like You can real-time update it. You can have 2 points of access and you will be using the same set of data. But now they are probably, I don't know how the reports are sent. So maybe they are emailing them. They are probably using Excels for these reports and all that. So there is an issue again. You can elaborate. So this is not a separate risk of material misstatement or a separate weakness in internal control. Here, under this, you can use this information also to elaborate that the systems are not integrated. This is a weakness in internal control and the systems are not integrated. Therefore, there can be risk of material misstatement because so many manual documents that you have to deal with. Then there is a risk of material misstatement. Then also this one. At the end of each day, the showroom cashier, I am again here. At the end of each day, the showroom cashier reconciles the physical cash collection and credit card payment receipts together with the system generated receipts list. So this we can say there is no segregation of duties. The same person is doing that. But of course, if you think of a small showroom of a small shop, obviously you can't have 2 separate people to be doing all the work. But of course, we can note it down as a weakness in internal control. That again I will write here. No segregation of duties in cash collection. The same person is collecting the cash, running the reconciliations. So that is a weakness in internal controls. Then that can be a risk of material misstatement also. This weakness was in the first weakness was in the information and communication. The second one is a weakness in the control environment. The third one is a weakness in the control activities. If you remember the stamps of the control activities, one of them was using segregation of duties, so which they have not used. It's a weakness in internal controls. Okay. Then we have, okay, so we come to this. Then from this, so this page is very important. But what I would recommend is that you somehow think of a way to carry this with you to the exam so that you don't have to read the pre-scene again. Save your time, your precious time, those 3 hours and 15 minutes for the actual value-adding reading you need to do. This thing you can read at home. So don't use the time to read that. Just make sure you remember what to write. Make sure you carry it with you to the exam. So that is that. That page is very important. Then we come to the next page, page 6, inventory management. Inventory management is one of the most important functions in supply chain management. So clearly, inventory management is important for the supply chain management and is also important for us also as the auditor or the accountant, because inventory, these people are into selling office equipment, printers, copiers, transformers and whatnot. So inventory is important. With the start of the use of ERP, users information systems for warehouse management, good. the company implemented the system module from the ERP system for inventory management. So on ERP, you have different modules. So they are using the inventory module on that. Currently, the company is using advanced barcode machines that support QR code and different requirements. Okay, good. Rack and trash tracking systems, good. Due to the partial implementation of the ERP system and delay in integrating the financial accounting package, EOSL is facing issues in tracking obsolete items as well as the values to record accurately in the financial statements. Okay, now again, one more thing you can write under integration issue here. Risk of material misstatement, systems are not integrated. One is obsolete items not recognized, and the other is valuation. So now this has a direct impact on the assertions regarding inventory. If you remember the assertions regarding inventory, we have something called valuation and allocation. Accuracy, valuation and allocation. So that cannot be properly done if you can't recognize the obsolete items and if you don't know the values also. So the reason is systems are not integrated. There is a risk of material misstatements because of that. This is not a separate one. This is just another point under why they should get their systems integrated properly. The company has failed to carry out annual physical stock verifications in a few showrooms and the main store due to the lack of labor during lockdown. Of course, yes, lockdown, so nobody could travel. Auditors are not magical creatures who can overcome all the COVID guidelines also, so you can't travel. Stock counts were not possible, but I have heard about people doing virtual stock counts also. What can the auditor do? So if you can't personally visit the stock count, what the auditor can do is the auditor can get an understanding about how the management did the stock count, and also a better way would be to do a subsequent stock count. So now they can go, if they audit in 31st of March, they can go now and then kind of do a back calculate, roll back, and then figure out the inventory, the stock as of that date. So that's what could have done. The company has failed to carry out annual physical stock verifications in a few showrooms and the main store. So now this is an issue. Just one store or two is, one showroom or two is okay. Of course, when you have so many showrooms, you cannot go and do stock count in all of the showrooms, but the main store not being able to do a main stock count at the main store can be an issue. So it is an issue because at least that stock count you have to do. So the company has not done that. So, and probably the auditor also could not go and check the stock count, audit the stock count. So this is an issue again, and we can put it separately also. We will put it as a separate one because inventory, again, similar to accounts receivable, there can be risk of material misstatement inventory. So one is this again here, obsolete items are not getting recognized, valuation, and then stock count is not done. So you actually don't know how much of inventory you have. So stock count is not done. That is a risk of material misstatement with the inventory. So this then now the assertion that was at threat here is the under the second one, that was accuracy, valuation, allocation one, and here When you have not done a stock count, the assertion that is at risk is the assertion of existence. Existence, we don't know whether those stock is there or not. So existence assertion is at risk. Okay. Then further, I'm again coming back to the pre-scene. Further delays in integrating the financial accounting package to the ERP system and invoicing system at the showrooms created many issues. Of course, what were they thinking? Many issues related to the financial reporting process of the company. As EOSL currently uses three main systems, yes, ERP, QuickBooks, and standalone invoicing system. Transaction details relating to sales and collections at the showroom level are handled by the showroom cashiers. And the daily transaction reports, together with the supporting copies of receipts and invoices, are sent to the head office. EOSL employs 5 accounts executives to feed data into the QuickBooks accounting package. Sales accounts executive, purchasers account executive, payments account executive, collection account executive, and account executive general. All other transactions handled by the account executive general. So we have, now you can see that at the head office, they have 5 account executives. At each showroom, you have a showroom cashier who does all the cash handling and raising invoices, transaction reports, etc. Then you at the head office, you have 5 accounts executive who will feed data into the QuickBooks accounting package. So you have a sales account executive and a collection account executive who go with the accounts receivable account. Purchase accounts executive and payment accounts executive comes with the AP, accounts payable, and account executive general, he does everything else. Then account executive general prepares consolidated daily transaction summary sheets by consolidating transactions of all the showrooms using the source documents that they receive from the showrooms and from the other head office departments of the company. These summary sheets are used for daily ledger posting. Once the account executives input data into the QuickBooks, the finance manager verifies those ledger postings with the daily transaction summary sheets prepared by accounts executive and approve the ledger posting. Finance manager prepares the financial statements. Okay, so now here what's happening, there is so much of manual data input. The cashiers at each of the showrooms prepare their own sheets, and then the accounts executive general, he prepares a separate summary sheet of transactions and he uses that for ledger posting. And then the accounts executive in those separate accounts executive, sales account executive will look at the invoices and then he will enter data into the sales account. Purchase account executive will enter data into the purchase account. Payment accounts executive and the collection account executive will look into the cash and the accounts receivable, accounts payable accounts. Then the finance manager will cross-check what the account executive general did with each summary sheet from each of the other 4 executives, and then if they are tallying, he will approve them. So this is a lot of manual work, as you can see. So many Excel sheets going up and down. This is again an issue with them not having integrated systems. So when you're elaborating this, you can add to this also. A lot of manual data entry. So when you don't have controls over data entry, there can be so many issues. If just one number is incorrect, then there can be so many issues in the financial reporting. So there's a lot of manual data entry happening. No idea whether there is any controls over data input. We have a separate section on these inputs and outputs in a computer. So no idea whether they have any controls over data input. Lot of manual data entry, emails going back and forth, and manual approvals also. The finance manager is checking it manually. Not that when you get 2 sheets, not that he's going to check them uh, through a system or something. So it's going to be a lot of manual work. And with manual work, what happens is there is a risk of material misstatement. What is that? Why is that? Because human error. It's human to make mistakes. So human error, we can actually categorize this part as weaknesses, risk of material misstatement on financial reporting. So we have the internal controls on financial reporting, and under that, on the general financial reporting, there can be issues such as when you are doing manual data entry and manual approvals because of human error. So that is another thing we can write down as risk of material misstatements. Then I'm again going back to the pre-scene. Finance manager prepares the financial statements of the company based on the trial balance extracted from the QuickBooks accounting package. So they're not using the system for preparing the financial statements. They are not using the system for that. They are only getting the trial balance, and then the trial balance, the finance manager will use the trial balance and prepare the financial statements. Financial statements are approved by the general manager and emailed to the secretary to the board to circulate to the board members for the monthly meetings. So now the board members, the quality of information that is given to board members, that is an issue. We need to note down under corporate governance. Let me write it here. Low quality of information provided to the board of directors. Why? Just the finance manager is using the trial balance he's getting from the system, and then he's using that to prepare a financial statement, prepare an income statement, which he's sending to the board of directors. And the board of directors are taking decisions based on that. So low quality of information provided to the board of directors, that is a weakness in the corporate governance. Because in the best practice for corporate governance, they are specifically saying the board should get accurate, relevant, up-to-date information to make sound decisions, obviously, right? Without proper decisions, you can't, proper information, without that you can't take proper decisions. So low quality of information provided to the board of directors, this is a failure in the corporate governance. The general manager finance, email to the secretary to the board to circulate to the board members for the monthly meetings. The general manager finance is responsible for the financial statements closing process of the company, since the QuickBooks system used by the company does not facilitate financial period closure. So now this is an issue. Why? Because when the system is not doing financial period closure, the person who's doing the accounting can go and make changes to the previous year or previous period also. So without a period closure as in after this date, once you have closed the accounts, you cannot post anymore to that particular account once you have closed it. So when that is not there in the system, if the system is open, then you can go and make changes to the previous months, previous periods also. This is a very big issue. we have to note it down under risk of material misstatements. We will write it under this. No period closure function available in the system. That is an issue. That is again an issue with the internal controls also. I am putting it under separate category called weaknesses in internal controls over financial reporting. Manual data entry is an issue, and also no period closure function available in the system. That is a big issue, a very big issue. So cutoff is an issue. So that is that. Accordingly, the general manager finance personally gets involved with the financial statement closing process and prints all period end reports. So he is doing the printing. That is, at least they have printouts of that. So if anybody wants, they can go and check whether any manipulation has happened after the period end, because the printouts of the reports are there. It's not the best, but it's okay. So what are these prints that he's taking? What are these reports? So it can be the aged receivables, aged payables, then payroll, year to date or month to date payroll report, inventory report. Those reports which show the amounts and the information as of each period end. He will print them out and then he will keep them. Subsequently, he files those printed statements in the master file maintained for the particular purpose. Now, he probably has a a folder of it. So, if fire or something happens, the entire the folder will be lost there. That is the issue with keeping hard copies also, and you don't know for how long you can keep these things, right? Like all of a sudden you might need that, but then it was 3 years ago and insects or something may have happened to that. So that is the issue. So yeah, that is again an issue with the system not being integrated, that he has to keep manual printouts of those things. Journal entries related to depreciation, amortization provisions and accruals are passed in the system at the month end, and system allows to backdate and pass those journal entries as well. So this is not good. The system allowing you to backdate and pass journal entries. Then journal entries related to depreciation, amortization provisions and accruals are passed in the system at the month end. So all of these, we call them estimates: depreciation, amortization, provisions, accruals. They are estimates, and estimates inherently have a risk of material misstatement. We always say that now. Estimates inherently carry a risk of material misstatement. Why? Because it's based on the management's judgment, and they can say, okay, this is the correct estimate, but it's based on the management's judgment and it's subjective. So that always carry more risk of material misstatement. Especially we say that when it comes to SLFRS 13, for example, fair value measurement. If you see fair value measurement anywhere, you should always remember there is a risk of material misstatement because it's an estimate. Similarly, these provisions also and depreciation, all of that are estimates. So some, of course, like depreciation and amortization, there isn't much that you can do with that because you are using the same rate from year to year. But provisions, of course, you can do a lot of manipulation. Then estimates, you are allowed to make changes, you are allowed to backdate them. That is a risk of material misstatement. So that is the system allows to backdate and pass those journal entries as well. So we can write this down as a internal control failure also, which is weak controls over journal entries. That is again weaknesses in internal controls or financial reporting. So over journal entries, they don't seem to have proper controls. That is weak controls over journal entries. Okay. The monthly and annual provisions for debtors and inventories are prepared by the respective accounts executives based on the information available to them. So this is not how you should do that, right? We have learned for debtors and inventories both. For inventories LTS 2 and for debtors SLFRS 9. That is not how you are supposed to do that, not based on the information that you have. So you have to get additional information. For example, inventory. If you are going to write off to the net realizable value, you have to get additional information to calculate the net realizable value. Then for debtors, if you're going to make an impairment provision, you have to calculate the expected credit losses and all of that for impairment purposes. So that additional information you have to get. So this lazy approach of the accounts executive to use the information available with them is not good. Again, it's a risk of material misstatement. We can actually put that under the risk of material misstatement for accounts receivable. So like I told you earlier, impairment could happen and accounts executive is using only information available to him. So for example, if he doesn't hear that the customer has gone bankrupt, he will not make a impairment provision. But that's not how the standard wants us to do. So that is a risk of material misstatement. Then for inventory also, we can write the same thing. Accounts executive is only using the information available to him. That is a problem with the inventory. Okay, then to ease the management of 3 separate IT systems, Chief Executive Officer and General Manager Finance have been given super user access, which allows access to any level activity in the system. So this is again not recommended. We should have authorization levels. When Chief Executive Officer and General Manager Finance, now this General Manager Finance has super user access and he is also the one who's responsible for preparing the financial statements. He can go and backdate journal entries, then he does the estimates. He's the one who's doing the printing. So he's a jack of all trades. He's the man. So he has super access. Now this can lead to management override of controls. Management is actually getting more power. So when they have super user access, whatever the other controls that may be there in the system, also they may be able to kind of override. So this super user access is not recommended because you should have authorization levels. We can again put it under weakness in internal controls over financial reporting. CEO, and CEO of course is one thing because he's somebody who's separate from the financial report in the entire process. But the general manager finance getting super user access is a bit of an issue. So obviously now don't be confused. Obviously he's higher up in the hierarchy, so he should have authorization or permission to authorize things, but then that should stop at that. He should not be the one who's preparing the document, who's posting it, and then also approving it also. That which again comes down to segregation of duties also. So that's the weakness in the control, and that again can lead to risk of material misstatements. Super user access. Okay. Right. So now these two pages are very important because we have a lot of risk of material misstatements and weaknesses in internal control. So these two pages are very important. Let me quickly go through my notes and see whether I have missed anything. Okay. So there's one more thing, which is that we have the invoicing. The invoicing system, if I go back up here, when I am now on page 5, when a customer purchases from a showroom, the customer makes a cash or credit card payment to the showroom cashier, and the showroom cashier issues an invoice together with the receipt to the customer. So this is there. Now this is an issue with revenue recognition because now I told you under risk of material misstatements, there can be risk of material misstatements regarding accounts receivables. Then there can be risk of material misstatements regarding inventory, which we have, account receivables also, which we have. Then risk of material misstatement on other financial reporting, such as journal entries, all of that. Then we have cash handling also. Then another one is the risk of material misstatement on revenue, because it's there significantly in almost all the companies. We should not miss it. So fifth one, risk of material misstatement on revenue recognition. And here what can be the issue? There can be two issues. One is actually the we'll come to that later also. One is they need to properly segregate whatever they have within one contract, one revenue contract, because they are selling goods and also there is a service component of it, so they have to identify separate performance obligations. We will come to that later, but in this part, the risk of material misstatement on revenue recognition is that they are issuing the invoice when the payment is made. But how should it happen? You have to recognize the revenue when you deliver when you satisfy the performance obligation. So in that case, it can be delivering the goods. Now it looks like they're taking a little bit of time to deliver the goods. So as soon as you receive the payment, especially at cutoff, for example, on 30th of March, you receive the payment. But if you are delivering the goods only on 5th of April, then that sale will not belong to that year ending that 1st of March. It will not belong to that year. So because of that, revenue recognition, this should not be like a proper invoice. Now there are store invoices where you just issue an invoice. So it can be something like that, but it should not be a proper invoice which you are using for ledger posting. But in this case, they are using that invoice. So that is an issue with the revenue recognition. So you can explain that. Issuing invoices without delivering goods. Okay, so that part is done. This is very important. Again, don't be prepared, like don't think I will go to the exam and read this. Don't do that. Think of a way to carry this to the exam. Okay. We come to the next part. Holding company and its subsidiaries. So here, very important for consolidation for you to remember the names, the abbreviations of these companies, who is which one, otherwise EOSL, all of these vowels and letters and all of that. Very confusing. EOSL is the holding company. You know where you can see where they're doing, they're selling copiers, printers. So here they have photocopier business, then printers, large format printers, all of that. And then they have outsource operations, rental businesses also, just a 5% of it. Then potential of generating 3 types of revenue: equipment sales, consumable sales, and service revenue. So equipment sales, so what you may have to see is, not in the question, but when you are recognizing revenue, you have to identify separate performance obligations as per the revenue standard. So that is there. That's why again we can write it under risk of material misstatement also. Different performance obligations. That is there. So there can be confusion regarding how to recognize what, and also especially considering you don't have a proper person overlooking the financial reporting process of this can be an issue. They may put everything into the revenue account at the point of receiving the payment itself. So that is a risk of material misstatement. Then they're saying the company had generated a significant gross profit in the financial year due to the high demand for the office equipment, higher markup. A higher cost of sales percentage to sales is reported during the financial year 2021. So this you can figure out from this analysis. You can do this on your own also. What they're saying is they had significant gross profit in the financial year due to the high demand. A higher cost of sales percentage to sales was reported during the, so last year was profitable, but this year was not as profitable is what they are saying. So here we had, in the previous year, the group had 44% GP margin. This year they have only 42%. That's what they're referring to, that they have not been very profitable this year, as profitable as the previous year is what they're saying. If we take the company, sorry, are we talking about the company? Yes, sorry. So we are talking about the company. Then in that case, last year we had 43%. This year we have only 38%. So that is what they are talking about. Reduced profitability. Herbert is optimistic. Okay, that's good. Then we come to the subsidiaries. So now this is a company where we have the holding company and the subsidiaries. Again, risk of material misstatement. What is the risk of material misstatement? Consolidation. Consolidation or group accounting. There are so many things that can go wrong when you are doing consolidation, because consolidation adjustments are complex, and somebody with special knowledge about that should do that, not just an accounts executive or somebody. Then you have to inform all the accounting policies, the group accounting policies, to everybody within the group. With in advance you have to inform that. So there is a risk of material misstatement on consolidation. In this case, one risk of material misstatement on consolidation, one indication is that they don't have the required knowledge in accounting. They don't seem to have the required skill to do the consolidation. And the other thing is, there, I wouldn't say it's very complex, but still, when you have several companies, not that the all of them are subsidiaries, but when you have several companies, it can be an issue consolidating them. So complex group structure is another reason for me to say that there is a risk of material misstatement on consolidation. So we have information regarding each of the companies, ECL, ECPL, EEL, what they are doing, HTL. So these are the companies, subsidiary information. I think all of the others are fully owned subsidiaries. So you can keep that in mind. Only HTL has a NCI, I think. Just see whether that's correct. So in the group structure here, you can see whether this is correct or not. So all of these are fully owned by USL. Only HTL is 80% owned by USL. There is another NCI also. Then we come to the financial strategy of the holding company. We don't care much about that. We have to look at the working capital, though, for our financial statement ratio analysis. On average, turnover of 60 days for inventory and 60 days of trade receivables. So they are saying 60 days is the trade receivables, but I have calculated the receivables collection days here, and it's coming to actually 162 and 124. This is for the group. You can do the calculations for the company. I hope now these are simple things not to do the calculations. So please make sure you do the calculations. I will share this sheet with you with all the notes also. So make sure you carry this also to the exam with you somehow. Be smart about how you are going to take that. But the only thing is, you will not have to use this in isolation. They will probably give you more information about another company. or they may give you two new companies or give industry figures or something like that. So most of the time you will not have to use these ratios that you are calculating, but still, to be on the safe side, make sure you do the calculations and carry them. We will come to this analysis and the interpretation of it in a little while. So the working capital days is there. And then pricing strategy within the group. The group's policy on intercompany transactions is to sell products at prime cost of the product without adding a markup. So remember, if by any chance you have to consolidate and you have to remove the unrealized profit in inventory, remember they are not keeping a markup. So you don't there's no unrealized profit for you to remove because eliminate because of that, because they are not adding a markup, they are selling at the prime cost. Then we have the strategic direction of the group. We don't care, that's for SL4. This paragraph is important for us. Steven Johnson, he's from USA, approached the chairman of EOSL and indicated his willingness to acquire a similar company through EOSL in order to expand its global presence. Okay, so now when you say through EOSL, where is EOSL? You have EOSL here on top. You have EOSL here. And you have each of these companies underneath that. So when they're saying through EOSL, what's going to happen? That this Steven he may want to invest in shares in EOSL, and then he may ask EOSL to acquire another company. Or Steven could even invest in one of these companies, and then that company can acquire this other company that he wants. So something like that could happen. What is relevant for us here is, I don't want to speculate saying, okay, this is going to be the question, this and that. What is relevant for us from this is, when there is a possible acquisition or a purchase of shares, sale of shares, there is incentive, management incentive to manipulate the account. So that is again a risk of material misstatement. Let me write it here. That's the sixth one, management incentive. Management has an incentive to commit a manipulation of the accounts, because now one person has super use access also. What they can do is they can show high profitability in the company, and then they can get high valuation for the company. Then whoever who's coming to invest in the company will have to pay more to acquire the shares owned by the current owners. So management has an incentive to manipulate the account. So this is not a risk of material misstatement only on just one account, but it can affect all the accounts. They can go and manipulate the inventory. Now they haven't done a stock count also. They can show high inventory and increase the profitability. It can have an impact on the trade receivables, on the sales account, on the purchasers account. It can have an impact on any of the accounts in the balance sheet or the income statement. So this is what we call pervasive effect. It has a pervasive impact on all the financial statement items. Management incentive. This is because of a possible acquisition. Use these words. So pervasive impact. It's nice when you write those things. So it's true that sometimes you may know this. auditing part of it is very practical, so you will understand it, but then you will not be using the technical terms. What's expected from you at this level is to use the technical terms also. So pervasive, that's the technical nice way of saying that it can impact all the items in the balance sheet and the income statement. Okay. Then, of course, it could be relevant for this. This could be relevant for the SL21, the valuation part of it. So, yeah. Then, COVID-19 and impact to the company, it's okay. The first few parts are okay. We will need that information to do the financial ratio analysis. Here they're saying imports are subject to 180 days supplier credit and payments are to be done in 180 days, which has a severe impact on foreign exchange exposure to the company. Imports are subject to 180 days supplier credits. What is this? Now, currently, because of these foreign exchange regulations, the restrictions that are imposed by the government, when you when you import goods, you cannot pay then and there itself. Normally, for foreign trade, you get like maximum 3 months, which is 90 days. That is again maximum. You won't get 90 days. So that is the normal terms of trade maximum. So, but now, because of the restriction, you have to open an LC and you can pay only in 180 days. 180 days supplier credit. You purchase in April, you can pay only after September. So, yes, 6 months. So that is there. This is actually bad. I mean, if you could pay today, then if the USD rate is going up and if it's currently 200, you can pay at 200. But then if after 6 months, if it has reached 250, I hope not. If it has reached 250, then you will have to pay at that rate. So that is actually a problem. But what the government wants to do is to reduce the foreign cash outflows, foreign currency outflows that is happening at the moment. So because of that, this restriction is there. And why am I concerned about that? Because one thing is the foreign currency translation. How have they done it? What are the rates that they are using? LKS 21, there is a risk of material misstatement. Also, there is a going concern issue, risk of material misstatement. There is a going concern issue because now they are not manufacturing, right? These people are not manufacturing. They are entirely reliant on imports for their goods, imports, and they have local suppliers also, but mainly on importers. So going concern assumption, if the if the foreign suppliers say, oh, come on, we can't wait for 6 months until you pay us, we are not going to sell goods to you, then this company will have no future. So there is a going concern issue for this company. So I'm not saying going concern is not there. Don't write going concern is not there. But there is a risk regarding the going concern assumption. Somebody will have to properly look at it. Of course, remember, it's the management who's making the going concern assumption. Now, Herbert, of course, has said he's very positive about the future. The company will recover from COVID and all that. The chairman has said that. But the auditor will have to assess whether the going concern assumption is correct. So this has been tested recently also, whether the going concern assumption used by the management is appropriate. Does the auditor think it's appropriate? So you have to write, you have to refer to this, that there is a risk because of this situation. But of course, if the management has a proper strategy in place, then the going concern assumption is appropriate. So you can write it depending on that. And also, certain local suppliers have reduced their credit period from 30 days to 15 days. Again, supplier issue, suppliers are demanding money quickly. So because of that, again, going concern issue. That is there. Then, at the recent board meeting, Danushka Pereira, General Manager Finance of the group, brought to the notice of the board that though the company has a better working capital management process, there is a major difficulty in cash conversion cycle as a result of offering a credit facility of 60 days to their corporate customers. And there is a high risk of default by customers during the pandemic period also. So that is again, where did I write accounts receivable? So it again comes to impairments. What is this person's name? Danushka has said high risk of default by customers. High risk of default by customers. Now what's the issue? Accounts executive is using only information available to him. Danushka is not saying this to the accounts executive. Danushka is saying this in the board meeting. So accounts executive will not provide for this impairment. So remember that high risk of default by customers, and therefore there is a risk of material misstatements in the accounts receivable. Harshana Silva, okay, we don't care about that. Danushka again. Who is this Danushka? Danushka, General Manager Finance. So he is the man. He is the one who has who does the financial statement preparation, who has super, who does the estimates, and he makes recommendations to the board of directors also. Danushka pointed out at the routine meetings of having a systematic risk management process as a priority. And this had been pointed out several times by the company's external auditor as well. So that is another internal control weakness, which we have to write here. No risk management framework. This is again an internal control failure, not having a proper risk management framework. Of course, you should have a proper risk management framework, especially considering that these people are dealing in foreign currency. So foreign currency, when you are importing, your cost of sales will go up when the rupee depreciates. You have to pay more money to buy goods, you have to pay more LKR, and then you have to because the depreciation, the rupee depreciation, LKR devaluation is happening. So especially in a situation like that, you must have a proper risk management policy. So that is a internal control failure, internal control weakness, and also it can reflect on the financial statements also. So we can note that also down. Okay, then that's okay. Then there is this thing, Rehan is now not well. So he has spoken to his elder brother, Herbert, the chairman of this group, and he has asked for a solution for his business venture before his death. So this you have to keep in mind because they have given us the financial statements. So next, we will come to that later. Just keep that in mind. Rehan's company is currently out of the group, but there is a possibility the chairman, being the kind brother he is, he may decide to bring that company into the group. So that is something we may have to consolidate for. Then chairman has not withdrawn any cash, but the auditor has observed a few payments done to the group chairman, Herbert, but did not receive any proof to verify the authenticity of this transaction. What is this? Related party transaction. Related party transaction, there is a risk of material misstatement on consolidation, and separately on the related party disclosure note also. If you remember, you have to, I am writing this under risk of material misstatement. Related party transactions not getting disclosed. There is a risk of that happening. You have to keep a related party transaction register where everybody records their transactions. So that may not happen. LKS 24. There may be a risk of material misstatement regarding LKS 24. So you can actually write that as a weakness in internal controls also, that they don't have this internal related party transaction register, things like other controls to properly monitor related party transactions. Because source documents are also not there. Okay, then we have the shareholding structure of EOSL as at 31st March 2021. So remember, now I always tell you this in the class. Now we come to the consolidation part of it. Always remember, you will probably get at least 2 dates in your consolidation effort, in your consolidation exercise. You will probably get at least 2 dates. What are those? In this case, this is 31st March 2021. And which is the reporting date. Reporting year end, not the reporting date, reporting year end. Then you will have another day. Always keep this in mind. So now for consolidation, I have told you the steps also. First of all, you have to figure out what the group structure is and what the transaction is that's happening. That's your first step. So you have to figure out based on the information that is given to you, what is the scenario. That's the first thing you have to do. What is the scenario? Whether this is a step acquisition, whether this is a step disposal, or whether it's a regular acquisition where you're acquiring fresh. Then you have D-shaped groups, vertical groups. So what is the scenario? First of all, you have to figure that out. And under that, one thing you may have to check is whether control exists. And when you are checking whether control exists, what you have to remember is that control can be based on other factors also, not only based on the number of shares, but you can have 30% ownership in a company, but still you can have control if you have other indications. For example, potential shares. If you have a share conversion option, then you have potential shares. All of these things we have discussed. So you have to figure out whether control is there. If control is there, it's a subsidiary. If control is not there, it can be a joint venture or an associate. So all these things, as the first step, you have to figure them out. And then as the next step, you have to, of course, figure out the controlling ownership, the percentages. You have to figure out the percentages. For example, how much is the NCI and how much is the percentage owned by the parents' shareholder. So if you have a complex group structure, those percentages will be different. Then also, I think the last thing we discussed was that for control, you are not going to use those other potential shareholding percentages. So those things keep in mind. Then from this question, the most important thing is you have to remember that you can get different dates. So that is where I was before I got into the other parts. So there can be different dates. Remember this, please keep this in mind. 31st March 2021 is your reporting year end, but then they can tell you that the transaction happened on 15th, let's say May 2021. So in that case, you have to be careful. You should remember that there is a difference between these two. 15th May is not good. Let's say that is September. You must remember that there is a difference between these two dates. So you have to adjust for it. We call this the transaction date. So always please keep that in mind. The make a because that's not given. For this question, 31st March 2021 is the information that is provided to you. So if in the question, if in the paper you are given information which says for the 6 months ending 30th of September 2021, please remember you have to use that profit, use that information when you are doing the consolidation. You have to make adjustments because you have to use the information that you have as of this date, and then you have to make those adjustments. So remember, 31st March 2021 is your reporting year end. Please check what your transaction date is and think of all the changes that should happen between these two dates when you're doing the consolidation. So shareholding structure, we have Herbert, Eric, Christina, 95,500. So keep this also in mind for consolidation. That is really like the individuals, how much each individual owns, that's really not relevant for us, unless of course in some past papers you had to determine whether when you have a director of a company having this much of shares, then does the company gets shareholding, if you remember that past paper. So there are things like that, but for now you can just note down the shareholding percentages under the group overview. We actually don't have information regarding the number of shares. So for consolidation, what you need to take from the pre-scene is an idea about what information do I have in the pre-scene and what information do I not have in the pre-scene. Because otherwise, when you go to the exam, you will be confused as to which information you should take and which information, where to find that. So what information do I have in the pre-scene? This is very important. This is what you need to take from this analysis for consolidation purposes. All of these other things are also important. But for this, you have to carry that. What information do I have in the pre-scene? So for one thing, I have the reporting year end. Then these shareholding percentages are also there. Then I have information next. So this Eastern Office Holdings PLC and market information, that's for valuation SL2 purposes, not for us. But just remember, if in some situation you have to use a discount rate to maybe take the present values, so you can take the 16% if it's not explicitly given to you in the question. In the question, they may tell you use 12% as your discount rate wherever applicable. In that case, don't use 16%. But if no indication of something like that is given, you can use this 16% as the market rate. And also, if for some reason you have to take the risk-free rate, you can use this 10%. This 10%, of course, will not change because that is the general risk-free in government bond yield currently 10%. That is okay. 16%, if they have explicitly told you to use this, use another discount rate, use that. If not, use the 16%. Okay. Then Annexure 1, challenges in printing industry. I don't care for it, so I'm leaving that. Then I come to the financial statements. So these financial statements I am using for two things. One is my financial statement analysis. So as you can see, we are running a bit late, but I will finish and stop. So the financial statements I am using for the financial statement analysis, and also to figure out what information do I have in the pre-scene. So I have done some of the ratio calculations here. What you should do is you also should calculate the ratios. One thing I have missed here is the inventory days. So calculate that. Based on the calculations that I have already done, I will kind of interpret these for you. Now, most probably, however, you will not have to use these same ratios in your exam, but just think of the way of interpreting whatever that you have in the exam. Also, if you don't know how to calculate all these ratios, now, for example, growth rates should be easy. I hope you know that you can take it like this, with the, like, you take the increased amount divided by the old amount minus 1. That's an easy way to do the calculation. So if I go to interpret them, now revenue has decreased from previous year to this year. Revenue has decreased. Cost of sales also has decreased, however. Then this is, I'm talking about the group. Then the GP margin also has dropped. So what has happened? GP margin has dropped. For the company also the GP margin has dropped, and for the group also the GP margin has dropped. Meaning now it makes sense for revenue to drop, but still the GP margins should stay the same, right? Revenue drops and the cost of sales is dependent on the revenue, obviously, because that's why you call it cost of sales. So that is a direct cost which is dependent on revenue. But here what has happened is the margins also have dropped, meaning their profitability is getting reduced over from the previous year to this year. The profitability has dropped. So here the revenue drop could be due to the drop in volumes or a drop in prices. But what they had said actually is that they are pricing for any exchange losses. So if they have to pay more LKR because of the rupee devaluation, the rupee depreciation, if they have to pay more LKR to import goods, then that amount they are charging from the customers. So that actually should not be a reason for the drop in the profitability. We have to figure out what this is something not that we have to figure out. So they have to figure out what has been the reason for their drop in the GP margin, because that the LKR depreciation is not a justifiable reason for that, because they are charging it from the customer. They're charging it from the customer. Therefore, they have to figure out what is the reason for the drop in this profitability. So you can write these two ratios and say that their profitability, the gross profitability itself has dropped. Then other income also has decreased from the previous year. Other income actually plays a significant role in this company, because when you calculate the operating profit margin is, this is excluding other income and finance income and expenses. You can see the formula, the amounts used for that. So the operating profit margin is 4.4%. But the NP margin is 9.7%. After now, from coming from operating margin to NP margin, the difference is this other income and also the finance income and finance expense. So here they have to they have a significant amount of other income. So we don't have information regarding what could be in this other income, but it could be the some kind of a extraordinary, unusual, non-recurring item. Maybe they have disposed of something, disposed of a PPE or something. Maybe that's why they have other income, but still the other income has dropped. They also are talking about some interest income from money market accounts, but of course, now this, if you look at the finance income growth, it has grown by 48%, which is significant, right? Almost by half it has grown. But still the money market, if you think about the money market, they have said here in the company always had positive cash flows and cash being held in money market accounts to generate additional income. So a money market account is something like a savings account, but you get, this is something that banks give for valued customers, like customers who have higher amounts of money deposited in their accounts. So they give a bit of a higher rate than the savings account. But since these companies now they have a lot of excess cash, if they wanted, they could have properly invested it in the Colombo Stock Exchange maybe or something like that, but they are not doing that. They have invested it in low risk money market accounts in another bank account. So in 2020, actually this year the interest rates were low. Now only those interest rates are increasing. The government increased the policy rates. Because of that, the general interest rates are also going up in the country, but previously the rates were very low. So this does not justify why the finance income has grown by this much, and also the finance expense also has grown by this much, because in this year the interest rates were very low in the country. Like the risk-free rate itself was around something 7%. So the interest rates were low. So we don't know why this finance expense has grown by this much, and also finance income has grown by this much. And also in the question, in the pre-scene, they have said that they have very little reliance on debt, which is true. Because if you look at the leverage ratio, this is debt divided by total capital. It's 12.3%. You have only 12.3% debt. It has increased from previous year from 7.5 to 12.3%, but still it's very low. Normally, a company can go up to even 70% of debt of their total capital structure. So, because with this whole concept of debt being less costly than the debt being cheaper than equity, so they have very low leverage, but still their leverage, the debt ratio is very low, but still they have very high finance expenses. So this is something we need to figure out. Why is that? Maybe they have one thing I can think is maybe they have taken the foreign currency translation, that whatever the foreign currency translation differences also into the finance expense. Maybe that's why, but that then if they have done that, that is not correct. So then interest cover ratio, of course, this looks satisfactory. They have 10 times. I mean, earlier they used to have 32 times, but now it has come down to 10 times. But still, it's satisfactory. So from this financial statement analysis, we cannot exactly come to a conclusion whether this company is doing good or not. So of course, there has been a drop in NP margins. NP margin has dropped by half, but of course we have to allow them, we have to give them a concession, because these are COVID times, difficult times and exceptional times also. We can't say that the company is is going downhill. We can't say that. It could be a temporary situation. These are points of concern for us. This very high finance expense compared to this low leverage. So what are the possibilities? Maybe they have not recognized their liabilities. Maybe they are underestimating their liabilities, or maybe for some reason they are not doing proper classification. If they have put the currency translation, foreign exchange translation difference also into the finance expense, then that is wrong classification. So that those could be actually material mistake. Those could be misstatements rather than an indication of the performance. So that's what I'm trying to say. These unusual ratios that we are getting, these ratios, now we check the connectivity between two also. So when we check the leverage ratio and the finance expense ratio, there does not seem to be a true correlation, like doesn't show what we need to see. So the possibility is that rather than an actual representation of the performance of the company, this could be due to misstatements. So keep that in mind. That could be a reason. But overall, the profitability has dropped. So NP margin has dropped from 18 to 9.7%. Operating profit margin also has dropped. GP margin also has dropped. So that could be due to COVID temporary situation, or this could be an indication of issues for the future as well. Then we come to the current ratio. So the current ratio is again satisfactory, right? You should have like 2 times is good for the quick the acid test ratio. 1 is good, for this 2 is good. Then our concern is with the receivables collection days and the trade creditors payables days. So receivables collection days has gone up to 160 from 124, and the group policy is only 60 days. So there's a significant discrepancy between these two. So that could be an issue why there could be impairment in these receivables, trade receivables. And also the company is obviously having cash flow issues, which means there could be going concern issues. Then trade creditors payables days also has gone up, and this could be a problem for the suppliers, and we may lose our goodwill reputation with them. We may lose our good relationships with them, and because of that, again, going concern issues could be there. Then you can actually calculate the inventory days and calculate the cash conversion cycle and see whether they are facing any cash flow difficulties also. So that is based on the information that we have. With this information, it's actually difficult to interpret what's happening. So just make sure you remember how to do the calculations and also carry these calculations with you to the exam. Then we come to the final part again for consolidation. So we go to the financial statements. In the financial statements, now I want you to remember what information you have and what information you don't have. So you have the financial statements, statement of profit or loss, and the statement of financial position for EOSL. You have the balance sheet here and the income statement on top on page 16. This is for EOSL. Which is the holding company. So consolidated accounts, EOSL consolidated account, financial statements. For EOSL, which is the holding company. So you have that information. Then, by any chance, if you are asked, obviously you will not be balance sheet for this company because you have how many now? 4. And if they are doing another acquisition, that will be 5. So that's too many for you to do the entire balance sheet. You will most probably be asked to produce an extract. So they will, which has been the case in the past papers also. they could ask you to prepare an extract of the non-current assets, or the current assets, or yeah, most probably non-current assets and equity and that part. So in that case, you have to use it depends on the situation. Most probably you will have to use information from this group column. Remember that. Because why is that? Because you have to now you will be given information about one company, but all the other companies' information, if you don't have, you will have to use this group figures, because it includes the information about the other 4 companies. I hope you are following me. So remember to take your balances from this group column. Most probably, it's not always, depending on the situation, you will most probably have to take information from this group account. Then now I don't think you will be asked to draw up the entire balance sheet, but still, if you're asked to do the non-current assets, leave space in your template for all of these. Now, you know that these things are already there, right? Property, plant and equipment is there. Lease asset is there. Capital work in progress is there. Then the goodwill is there. Intangible assets, investment in debentures, loans receivable from related company, and deferred tax asset is there. So when you are drawing up the template, use lines for all of these from that. Then if you have to, now thankfully we don't have any associates in this, so that we don't need to discuss. Just see that there is goodwill, and from the previous year to this year they haven't done any impairment. The goodwill has remained the same, so no impairment. But if in the question they have told you some indication regarding the impairment of goodwill, you have to make that. Keep that in mind. Currently, no impairment has been done. Then that is the information that I have. For the holding company, I have the group accounts and the individual accounts. Then I have IOSL, Innovative Office Solution Private Limited. I have the statement of profit or loss and the balance sheet. So now what is this IOSL? IOSL is this person who is outside of our group. He's not in the group, which is owned by Rehan. So I have IOSL separate financial statements also. I have IOSL separate financial statements, which is not part of the group. So not part of the group. If you have to consolidate that into the EOSL group, if they are acquiring IOSL, because that's the discussion that's going on. Herbert, being the kind brother, is trying to help Rehan, the dying brother. So I'm not making fun of a dying person, but so if you have to consolidate these two, then what you will do, you will take the group figures from EOSL, from the group column, and you will use these, sorry, not these, you will use the balance sheet items from this to do the consolidation. You will use these items. So in that case, just see what are the common items, right? Property, plant and equipment is there in both, intangibles in both, right of use assets in both. Other investments was not there in the previous one, right? They had something called debentures. They had, investment in debentures. So you will have a new line here if you have to consolidate those two and you are drawing up a template. Not the full template, but if you are taking the non-current assets also. Then also remember, if you have to consolidate this set, these may not be the balances that you have to use. So now you have stated capital, general reserves and retained earnings. So these are given as of 31st of March 2021. If they are telling you the consolidation happens on 31st of March 2021 itself, you can use this information. But if the acquisition happens later, like I said earlier, 30th September 2021, if that is the case, then you should look for new information in the unseen. In the question paper, you have to look for new information regarding the equity balances to do the goodwill calculation. Keep that in mind. Then, or else what they can do is they will tell you to use this information, and then maybe will give you the profit for the next 6 months. In that case, you have to adjust it to this retained earnings figure. So keep that in mind. I'm not saying you will be asked to consolidate this other company, but since they have gone to the trouble of giving us this income statement and the balance sheet, it looks likely. So that is IOSL. You have information for IOSL again as of 31st March. Keep that in mind, very important. 31st of March. Okay, as of 31st of March, because these are the, now I am not saying anybody can score full marks for the consult question, but of course these are simple things that you should not make mistakes. So as of 31st March 2021, if your acquisition date is, be careful about the acquisition date. And any transactions that may have happened between that period. Keep that in mind. So next I have Heller Transformer Private Limited. So finally I have some information from the group also. EOSL is there, IOSL is there, then I have HTL. HTL is there. HTL separate financial statements they have given me. That is again as of 31st of March. Now, don't go to consolidate as of 31st March itself. You should not be taking into these HTL amounts into the EOSL, because already in the EOSL consolidated accounts, HTL is consolidated. So keep that in mind. Even though HTL is given separately, this is there within the 31st of March consolidated accounts of the holding company EOSL. It's there. So we are not going to add it separately. Here, when you take the property, plant and equipment, this amount, HTL's amount is included, which is for this. What you have to see is there could be a possible impairment, maybe some kind of an impairment indication if that is given, because they were saying that this company is making losses also. So that there could be something like that, but just don't think too much about it. So we have the financial statement and the income statement of Heller also. So these are the information that we have. For HTL, I have separate financial statements. IOSL, I have separate financial statements. EOSL, I have the consolidated accounts, which I will have to use. If by any chance that foreign person, Steven, uses HTL as his vehicle to acquire another company, then you may have to consolidate at HTL's level. So maybe that is why they have given you the separate financial statements for that. In that case, it will be only 2 companies that you have to consolidate. So that is that for this. This is the information that I have. I don't have the number of shares anywhere. I don't have the financial statements. Note down what do I not have also. I don't have the number of shares. I don't have the separate financial statements for the other subsidiaries. For ECL, EEL, and ECPL, I don't have separate financial statements. I have only for HTL and EOSL. Keep those things in mind. And then the next step should be you have to always follow the template, right? If you are calculating the goodwill, just don't now most of the time what you will have to do is calculate the goodwill and then advise on the consolidation. So always first write the template. For example, the consideration transferred, and then if there is NCI, fair value of NCI. Then if you are talking about a step acquisition, the remeasurement of existing equity interest, like that. Then less fair value of net assets, net fair value of assets identified by assets, then any other intangible assets, contingent liabilities, all of that. Please make sure you write the template, because I have seen this happen to a lot of people. When you have figured out the scenario, after you figure out the scenario, write down whatever the relevant template for calculation of goodwill under each scenario. If it's step acquisition, it's different. If it's a step disposal, it's different. Then likewise write down the template, otherwise you are going to miss out on something, right? Because you have to look in the pre-seen, you have to look in the unseen, then you have to think also, so you will miss out. Because of that, always make sure you write the template before you do the consolidation. I'm talking about this template. Don't go to first write down the like the PPE, that full template for the balance sheet, because most likely you will not be asked to prepare a full balance sheet in this scenario, because you have 4-5 companies in this. So that is our pre-seen analysis. I will share this sheet with you along with some more ratio calculations. Please make sure you think of a way to carry all this information to the exam. Please read the relevant sections of the pre-seen, only the relevant sections. Don't waste your time on reading the unnecessary sections in the pre-seen. Read only the relevant sections. Please make sure you read and be familiar. Also, please make sure you are familiar with these abbreviations and the names of these people. That is our pre-seen analysis. Then on general guidelines for your exam, please make sure you stop on time. Stop on time for each question. And also please make sure you read the question properly. These are very simple things, but it can come in handy because by pressure, you're stressed, you're worried about, lots of things. Some people may be even sitting for all 4 subjects this time. So forget all that pressure and read the question properly. Just see what's expected from you. First read the question and then go to the description. Then use the first 15 minutes you get wisely. 15 minutes for reading, use it wisely. So most people like to start from the section 2 also, like the third question, but I wouldn't recommend it. Again, for the same reason I told you, this section you just have to copy paste in your, you just have to reproduce it. So the same thing, so you can save time from that. You will be wasting your first 15 minutes if you use that time for your consolidation question. What you can do is you can use the first 15 minutes of reading for your first question, read it, and kind of jot down the answer. Don't use the 15 minutes to read the entire paper, because obviously you are not going to remember everything, right? So just read only one question. If you are starting with the third question, read only the third question. If you are starting with the first one, read only the first one. If you are starting with the second one, read only the second one. Don't go to read the entire paper in the 15 minutes, because it's not like you can choose no all 3 questions you have to answer. So make sure you use the 15 minutes wisely in your exam. Then also these parts are okay. Consolidation. And then the other thing is try to read. I have highlighted this before also. Revenue standard and the SLFRS 3 business combination standard. Revenue standard and the business combination standard. Please try to read before you go to the exam, the 2 standards, so that you can refer to it and write any answers that are relevant. And please make sure you have all your open book materials ready to take with you to the exam. Audit standard books, of course, I'm not sure, like there's a lot of it, how much of use it's going to be. If you have it, if it makes you comfortable and confident, take it. So yes, in terms of general guidelines, that's what you need to do. Very important that you stop on time, that you properly time each of your questions, and that you read the questions properly. And also please make sure you don't just do the sum and come. This also I am repeating every day. Don't just do the sum. Explain. Okay, so this is not A-level accounting where you just have to do the calculation and they show it, but always try to explain it. Not simple things, right? Not simple things, but the logic of whatever that's done, always try to explain that. Then finally, you have a week to go. This time is more than enough. Of course, you need to have studied a little bit earlier, but more than enough. I think most of you may have already gotten full weeks study leave also. If you have that, then that's great. So this time is more than enough. You can do well. You can get through the exam if you wisely use this time. Make sure you properly time and do at least 2 past papers before you go and sit for the exam, because time management and being prepared to write a proper answer is key to getting through the exam. So that is it from my end. Let me check whether we have any questions in the chat box. If not, thank you to all of you, and all the very best of luck for you for the exam. Hope you all do well and get through the exam. All the best to all of you, and thank you for joining the session today. I will share this. With our IOEL admin team, and they will send the sheet to you.